We are now on to our final panel for the day. It brings us to one of the most urgent and investable topics of this decade, clean energy. Please welcome our moderator, Bella Landymore, the co-CEO of the Impact Investing Institute, and her distinguished panelists to explore how investors are unlocking infrastructure growth, co-investments and innovation in the green economy. Please, can you welcome our panelists to the stage?
Good afternoon. We're the final panel. So we're going to bring some energy, some challenge, and we're going to send you out here into the sunshine to have some drinks. Thank you for staying around to join our discussion on the realities of clean investment. So we're going to move this afternoon beyond the headlines of the green gold rush and explore what's actually happening when ambitious targets meet the realities of financing. I'm Bella Landymore, co-CEO of the Impact Investing Institute. We work for a greener, fairer, more resilient economy, and we work with across the capital markets to put those principles at the heart of the way in which they invest. And so just a shout out to the declaration on everybody's table, where I would like to particularly call out the declaration to invest in ecosystems that support sustainability, inclusion, and resilience, because that strengthens global finance. That is absolutely what we believe as well. So, to introduce our panelists, we have, in the middle, Tanya Songini, bringing us the investor and developer perspective. You hold a portfolio of NED roles, including the UK National Wealth Fund, Thrive Renewables, and Energy Systems Catapult, and with a background leading Siemens Energy's UK operations. You've seen both the engineering realities and the financing challenges of investing in clean infrastructure. Thank you. Dr. Ben Caldecott, here on my right, is the founding director of Oxford's Sustainable Finance Group and the UK's first endowed professor of sustainable finance. He leads the National Centre for Greening Finance and Investment, so you know where the money is and where it isn't. And finally, at the end here, Jerry Stokes, you've led a long career in the global solar industry, from startup to global operations, and the full energy cycle from tech development to grid-scale deployment. So you're bringing insights from across the ecosystem, from material science to energy storage to policy advisory. So we really have three people that cover literally everything you want to know here. Their NED portfolios are extraordinary, so that was just a snapshot, but I'm going to extract your nuggets of wisdom as we go through. And I think my first question probably needs to go to Ben and Jerry. What would your favorite clean energy powered ice cream flavor be? But maybe you want to ponder on that one as we go through this afternoon's panel, and you can give me your answer at the end. But I felt like we couldn't let that one slip. So on to the meat of this afternoon's panel. Jerry, I'm going to kick off with you. Give us the hard sell. What is the business case for investing in renewable infrastructure?
Well, from a solar perspective, first thing we need to think about is energy security. Forgetting about geopolitical risk, wind, solar energy, nobody else is dictating how you receive that energy into your own country. Second is speed of deployment. If we take solar, almost a terawatt of generation for solar energy was deployed in the last 2 years. So we can deploy these technologies extremely quickly. And thirdly, these are dependable, reliable, proven technologies, and they already provide the lowest cost of energy generation.
Thank you. A concise, compelling case. So, Ben, is this the reality? When we look at the investment trajectory, what is the gap between what we need to see flow and what is actually happening?
Yeah, great question. Obviously, there's been a massive surge in investment in clean energy over the last 15 years. That's still well below where we need it to be to deliver energy security benefits, to achieve net zero, and so on and so forth. And I would commend to you work by colleagues at Bloomberg New Energy Finance and any number of other organizations that show you how much investment is going in different bits of the world and how that geographical distribution has changed. Obviously, it's started in Europe and North America and China, and now that investment surge is continuing in Latin America, Sub-Saharan Africa, Southeast Asia, South Asia, and so on. But one other point I wanted to make was around the cost of capital and how financial institutions and investors are viewing clean energy and how risky they're viewing clean energy to be. What are the risk premia facing clean energy projects around the world? So my team at Oxford, since 2001, we've been tracking risk premia in the energy system, upstream, midstream, downstream, around the world, across different geographies, looking at how risk premia have changed over that period. And that's really important, also because the transition that we're talking about is about CapEx. It's a capital-intensive transition, and so the cost of capital is essential for the economics of this stuff. And essentially what we've found, and this is a very complex picture around the world, and you can look at these data sets, they're online and publicly available, is that broadly you've seen a very significant reduction in the cost of capital for renewables, solar, wind, onshore, offshore. You've had a very significant, appreciable rise in the cost of capital for coal, and you haven't seen much of a shift in relation to oil and gas. And this is interesting for a variety of reasons. One of the reasons it's interesting is if you're interested in achieving the aims of the Paris Agreement and tackling climate change, you want the cost of capital for the clean stuff to go down, and you want the cost of capital for the polluting stuff to go up. And so whilst we've seen the cost of capital go up for coal, we haven't seen that for oil and gas, and some people would argue that's a bad thing for the climate. So I think when we're looking at investment trends, we should look at the headline numbers, the quantum, but we should also look at the cost of capital and how these risks are being perceived.
Thank you, and I hope we can dig into that as we start to talk about the different financial pools and the opportunities that they're presented with. So moving on to you, Tanya. The UK has ambitious targets, but it's competing globally for capital. So where do you see the UK's competitive advantage? And where do you think it might need to go up the curve? Which other jurisdictions can we look to for inspiration?
Okay, so I will be coming at this very much from the perspective of being a non-executive board member on the board of the National Wealth Fund. And as we heard this morning from Brandon and Dominic, the UK has the advantage of being a very stable country. It is ahead of the curve in many ways when you look at clean power. And with this government, that strategy is underpinned by Clean Power 2030. There is a lot to invest in the UK. By 2030, we need to triple the capacity in offshore wind and solar in this country. We need to double our onshore wind capacity. We need to quintuple our battery storage capacity. The UK government supports this with mechanisms such as the contracts for difference, which give investors that certainty in the price stability, depending on the mechanism between 15 and 25 years. Besides renewable energy, we will also see low carbon sectors becoming key to the equation in the UK, so we need to see growth in green and blue hydrogen. And there again, the UK has put in place business models for hydrogen that help to close the pricing gap between grey hydrogen and green and blue hydrogen. And the other area which will be vital here in a system that is dominated by renewables is flexibility. Not only consumer-driven flexibility, but also more battery storage, more long-duration storage, and new technologies there as well, such as compressed air or liquid air long-duration storage. As I said, the UK has the advantage that it is very supportive of all of these technologies. It has the mechanisms in place to give that certainty over 15, 25 years so that we can grow in those areas. The UK offers an industrial base and the skills to support this industry. But we have a challenge there as well, so a lot of investment will be needed there too, because to achieve that ambitious capacity in energy, in low carbon energy I just described, we will have to really scale up our supply chain and skills. And I think in the UK in particular, localize a lot of the supply chain. We are still far too dependent on things like cables, vessels, transformers, on suppliers from abroad, and there is no reason why the UK can't become stronger in its localized supply chain. In terms of where we could look at for examples of how we can accelerate even further, I think one of the key problems, particularly in renewable energy, is the permitting and consenting. The process is far too complex. I think we can look towards European countries like Denmark and Germany, who have really streamlined that process in the last couple of years. And the other lever, I think, hasn't been pursued in the UK sufficiently, is community energy. And again, there we can learn from France, Germany, the Netherlands, Denmark, how to accelerate that. Because you always also there have the buy-in of the public, because they are part owners of those assets. Drive Renewables, which I'm on the board of, does quite a lot of community energy, but it's one of the few, so we really need to do more there as well.
Thank you. And actually, Ben, do you disagree with any of that? You've got a great oversight of the policy environment of globally. What would you say to some of those assets and challenges that Tanya raised?
Yeah, I mean, I think, look, I also serve on a couple of things in relation to the UK government. I think it's important to convey that we do have this very ambitious Clean Power Plan. We have a legally binding framework in the context of the Climate Change Act. But I think it's important for me as an academic also to be, honest with people thinking about investing in the UK. I did kind of giggle to myself when you said we're a stable jurisdiction. I mean, maybe.
Comparatively speaking,
well,
these
indeed,
days.
Indeed. But I think, there is anyone thinking about deploying capital anywhere, but particularly in Europe, does need to reflect on the policy and political risk. And that's not to say that you shouldn't invest at all, but I just reflect on a few conversations I've had over the last few weeks with people that follow politics in Europe and the UK much more closely than I do, pollsters, people doing focus groups around the country, former MPs and so on. And they've all said it's plausible that Nigel Farage might become Prime Minister. And that is not being priced into how investors are thinking about the UK, and I'm afraid you've got to have to think about it. That's not to say that the UK is not an attractive place to invest, and so on and so forth. But these fat tail type outcomes need to be factored in, and that's something we're just going to have to talk about and be open about, unfortunately. But that's one thing I would add.
And Jerry, how would you build on that? What makes a market attractive for investment in this area?
Well, I think we need to understand that the market is changing, and if we take the UK, a lot of the focus has been on building large, centralized types of assets, so large solar farms, ground-mounted solar farms. And the reality is that we also then face pressures from agriculture for use of farming, and so the real market opportunity for solar in the UK is going to be looking at all of those rooftops which don't have solar on. And that will be both residential rooftops and commercial and industrial rooftops. One of the companies that I'm supporting is a company called PowerRoll Solar, and they have a flexible, lightweight perovskite technology, which is extremely lightweight and can go onto all of those low load-bearing roofs and can also go onto the walls of buildings. Now, this may be difficult to think of from an investment perspective because it's much easier for an investor to look at a big solar farm. What's inside the fence is what you've invested in, what's outside you haven't. But what we've heard about earlier today is all about blockchain. It's all about these different disruptive ways of being able to think about investment and trading. And the reality is we can use blockchain to create virtual power plants so that you can trade dispersed assets. So suddenly, millions of rooftops, tens of millions of square meters of industrial rooftop can all be traded together as a virtual power plant. And this fundamentally changes the way in which we need to think about the investment opportunity in countries like the UK, where land is going to be scarce for building large assets. And so I think we're building a lot on what we've heard already today about the disruptive nature of this digital disruption and the role that it's going to play on the future energy scenarios. And that model is applicable everywhere in the world, actually, because rooftop solar, generating there, using the energy when you're in the house. But for all of us, if we've got solar on the roof of our house, what's it doing today? We don't need it because we're not there. So being able to trade that seamlessly in the background, automatically, digitally, through using blockchain, etc., is the way that the market's going to move forward.
Would you say that is the sort of most exciting and viable trend that you would call out? And indeed, do panelists have any other hot trends that they'd like to throw in the mix alongside Jerry's?
So just to complete the topic then, so of course there is now floating solar, so on the tops of reservoirs, for example. Well, that creates, effectively, it's not land that's being used for agriculture per se, but there are also great benefits in reducing the amount of evaporation from a reservoir, so you get a double benefit. We also see agrivoltaics coming in. This is where you combine some feature of the solar and agriculture. And so, for example, because of the global warming and the extreme heat, many crops are really suffering. But to put solar 5 or 6 meters up in the air above those crops not only generate electricity, but it provides much needed shade to prevent the crops from being damaged. And so we're being much smarter now, rather than just thinking in old ways of generating, which was build a big solar farm and think of it just as a solar farm instead of a coal-fired power station. So it's very innovative.
No, and just to support what Jerry is saying about the decentralized energy system, I mentioned flexibility before. That involves assets like battery storage, but it also comes down to consumer flexibility, where without putting new assets out there, you can manage demand and supply. And so we're increasingly seeing more and more of that, but it requires the digitalization of the whole energy system. So that is an area where the UK is quite strong in, and I would like to see more growth there. I think it is an area where it is probably ahead of the game compared to most countries in Europe, for example.
Thank you. Can we move on to the topic that you started, Ben, when talking about risk? There's a lot of talk about blended finance and how we manage for models, new models, innovative models, unproven models of investment, and the role that blended finance can play in catalyzing and supporting these. But what do we actually mean? Why is it needed? And can you give us an example of how it's working in practice?
Yeah, I mean, I think, well, what it actually is, opposed to what some people might mean by it, I mean, I think what it is risk transfer, right? You're transferring risk essentially from the private sector to the public sector. And sometimes that makes a lot of sense. Sometimes it can make a lot of sense for the private sector and not a lot of sense for the public sector. And the challenge is finding the kind of that win-win space in the Venn diagram where the investors are getting something out of it, the private sector is getting something out of it, and the public sector is also getting something out of it. And I think, you know, we've got to view it in that way. And I think there's some areas where policymakers have got it right. I mean, an area where there's constantly been essentially that form of risk transfer, or forms of risk transfer, has been around export credit. So export credit agencies, for example. You know, the UK has the world's oldest, not largest, not anymore, but the world's oldest export credit agency, UK Export Finance, that is now experimenting with some actually very exciting, very innovative forms of risk transfer. So if you've got anything that might promote UK exports, there are actually some very flexible financing facilities available, much more so than in other jurisdictions, and that's something that I think is proving to be a success. But there are any number of examples where blended finance has gone too far the other way and has not delivered value for money for the public sector and the public sector balance sheet. And so we've got to evaluate these things. I think, you know, perfect can be the enemy of the good as well. So if governments are too risk averse, then, you know, private capital can go off and go into other places. I'm a big fan of approaches that is sort of linking back to the previous conversation, actually. I think governments taking subordinated tranches of issuances is a good way of sharing some risk and ensuring that companies and investors you know, are not kind of fully protected by a wrapper and therefore get lazy. So if you've got a wrapper protecting you, you don't spend as much time as you ought to understanding the underlying asset, the underlying cash flows. And we need that to happen because we want often transactions to happen again and again. So subordinated approaches tend to be better, I think, than wrappers.
Thank you. Tanya, that leads nicely on to, you're Ned at the National Wealth Fund. So, Ben describes blended finance as a win-win for public-private risk sharing. Can you talk us about a bit more about public-private partnerships in action and the role of the National Wealth Fund in this space, and I guess some of the tips Ben has given in terms of when it's appropriate and how the National Wealth Fund does that?
Yeah, I'll bring it alive with a few examples. So the National Wealth Fund, originally the UK Infrastructure Bank, was born 4 years ago. Our remit was expanded with the change in government last year. So we have been capitalized with about 28 billion, which I know pales in comparison with some of the numbers we heard earlier today, but it's a good start. And we are there to work with local authorities and private investments, the private sector, to enable infrastructure and more recently also industrial growth in the UK. The sectors we focus on are clean energy, green transport, digital and technology, and advanced manufacturing. And with this government, we've received an extra 6 billion to invest in CCUS, green hydrogen, ports, gigafactories and EV charging, and green steel. So we're there along the life of a project, whether it's an early stage project that can't get investment from the private sector because it's too risky, we will take an equity stake. And there, for example, we've invested in a liquid air company in the UK. We've invested in a flow battery company in Scotland. We've invested in supply chain areas in the UK that the private sector still sees as too risky, such as a cable factory, an aluminium cable, HVDC cable factory in Scotland, or a lithium mine in Cornwall. We provide loans and guarantees. So, for example, recently there's been the close of the Sunderland gigafactory, 1 gigawatt gigafactory in the northeast of England. We first provided a bridging loan and were then able to crowd in commercial loans by providing a guarantee to AESC, and the banks who have invested in that project. So we're open for business. If any of those areas I've mentioned are areas you are looking at, please come to me and we can discuss what is possible.
Thank you. And just a quick follow-on, because already we've brought up the role of the future of energy is much more localized, the role of community energy. We talked about more consumer-centric models. The National Wealth Fund is an example of an institution that's really driving at the local impacts of energy transition. Can you just give us a sort of your quick opinion on how we ensure that this gold rush doesn't go to where the money is already flowing, and how we ensure that we don't leave communities behind?
Yeah, well, the double mission of the National Wealth Fund is the sectors I mentioned before, a green economy, but also economic growth, and in particular in the areas of the UK that are less prosperous. So I think, for example, the essentials there before you even look at concrete projects are connectivity, whether that be digital connectivity or transport connectivity. So the National Wealth Fund has invested through loans and guarantees in a number of broadband rollout projects in rural areas and poorer areas of the UK that weren't being prioritized. And it has also invested in a number of mass transit projects, again, in the northeast and northwest of England, less prosperous areas of the country. A lot of the supply chain loans we've provided, or equity stakes, are again in disadvantaged areas of the UK, 2 mines in Cornwall, 2 ports one in the northeast, one in Scotland. The cable factory is also in Scotland. So generally, we are looking to invest specifically in those, let's say, the old industrial hubs in the UK that are in desperate need of redevelopment. And the linkage with the offshore wind capacity being built in the UK is very important, because a lot of those areas can now become hubs for offshore wind, be it for the assembly and staging of the direct supply chain, but also the wider manufacturing around an offshore wind plant.
And I mean, you say this is regenerating hard-hit places,
Yeah.
places that we left behind, but there's an economic imperative here as well, and an incentive to invest in the drivers of economic growth, which energy being a key driver. Jerry, that's all well and good, but we've touched on some of the constraints here, and a big one being capacity, local supply chain, skills. Where do you think that these are bigger constraints than the actual capital flows, and how do we address them?
Certainly right now, the momentum and support from the government has certainly given a real shot in the arm for most of the renewable industry in the UK. And because it's been quite stop-start over the last years, it's meant that for a person thinking about a career in the renewable energy industry, it's been quite a difficult one to imagine that there's any long-term future. That is now changing, and I think that we need to realize there are constraints right now. There are skill shortages. The industry is very aware that it needs to train people up, but there is a growing confidence that finally there is a long-term support for the deployment of renewables. And behind that, the people who we're thinking about, who we want to bring into these industries, are people who are at school today. They're people who are at college today. They're people who are looking to start their first job. And it's a reality that most of those people, the only car that they will ever drive will be an electric car. Their house will be heated by electricity. Thanks to recent legislation in the UK, new houses are going to have solar built into them. So I think that actually gives a great deal of confidence to people that when they're living in that life and they're seeing solar, they're seeing wind, they're seeing the contribution it can make, it's all around them, that will give them the confidence to embark on a really very exciting career in renewables. There are already over 7 million people working in the renewable energy industry globally, and we can see that's just going to accelerate tremendously.
And I mean, back to Ben's point about the sort of worrying political future that we might face into, and the anti-green energy backlash, if we are building that infrastructure and providing a vision of good job opportunities for young people, I don't know, I optimistically think that we might be able to sway the public in favor of this green energy transition, but we really need to put our foot on the accelerator.
And the cost of, take solar, the cost of solar has fallen so dramatically that actually, somewhat regardless of who's in power politically, if you can make your energy bills almost be non-existent, why wouldn't you do that? Why wouldn't you enjoy driving your car around knowing you generated the energy yourself? So you're actually kind of immune to that. But the real benefit comes if government has the wisdom and the vision to enable the legislation that individual householders can trade their energy, because then, apart from being self-sufficient for energy, any surplus you've got can actually go to the good of other people being able to use that renewable energy.
Thank you. But of course, we couldn't conclude this panel, Ben, without touching on the rather gloomy global political environment when it comes to clean energy. If the US pulls back from clean energy leadership, do you think that creates a space for the UK and for Europe, and indeed Asia, to capture this investment, or is it undermining the whole global transition?
So it's definitely not undermining the whole global transition at all. And I would also push back a bit on the idea that the US is somehow completely pulling back from clean energy policies and action. Sure, we've got the Inflation Reduction Act, and we have, significant changes to that likely. I mean, who's been investing in US clean energy for the last 15 years? I mean, if you have been, you have seen a lot of policy risk. Do you remember, the production tax credits, for example, that, only get renewed or don't get renewed depending on what's going on in Congress, and investors have still managed to deploy lots of capital in the US. And there are lots of course, other drivers. The big other driver that we haven't talked about on this panel is, of course, AI, and the US realizing that, look, if we're going to win this against China, we've got to win on chips, and we've got to win on power, because we need the power to power the data centers and the hyperscalers. And so there are very significant drivers beyond federal tax incentives that are going to drive forward US investment. But also the reality is US investment in clean energy is something like 15-20% of global investment in clean energy. So let's not kind of take it out of proportion. I think there's a kind of quite an interesting question around, and this has been talked about before, around the rotation out of US dollar assets into Europe and to other places too. Clearly, if you're going to be allocating and then deploying more capital in Europe, I include the UK in Europe, you're going to need to really know your stuff on sustainability and climate change. You need to do that anywhere you invest, but particularly in this market because of the technological drivers, the policy, the regulation, the law, the reporting, all these things. So I think that will actually be quite an important, interesting dynamic for the investment management industry. So yeah, I'm quite sanguine actually about it all.
Excellent. So it feels like we're finishing on a pretty optimistic note. I want to come to each of you, in addition to your green energy powered flavor of ice cream. Can you tell me each the one thing the investment community is getting right about clean energy, and one thing it needs to do differently or more of? And we are at time, so snappy. Ben, I'll come to you first.
So a lot of the work I have done recently is on transition plans, and essentially one thing that investors are starting to do better is to focus less on paper decarbonisation, which is let's set a decarbonisation target for a portfolio and then exit polluting stock to meet a target. That does not make the world a better place. It does not affect real economy emissions. And so the mirror image of that is that investors are starting to focus more on real economy emissions and what they do to support decarbonisation in the real economy through other means, and that's a very important development.
Excellent. Thank you. Tanya?
Please continue to do more investment in renewables. We need it in the UK and in Europe more broadly, in an interconnected energy market. And in particular, I think, because of the UK ambitions I was describing before, we need more storage, long duration storage as well, and dispatchable energy. So please do take a closer look at those technologies too. And as I say, open to have a chat.
Thank you.
So we call this green gold rush, but I think that's really unfortunate because gold, there's only so much of it in the ground. And in the gold rush, thousands of people went looking for it and hardly anybody found any. The reality is, with renewable energy, it is abundant. The sun is not going out anytime soon. The wind is not going to stop blowing, and the fuel is free. If that doesn't make it investable, I don't know what is.
I couldn't sum it up better myself. Thank you so much, all three of you, and thank you so much for joining us.